The world of trading and investing has seen countless figures rise and fall, but few have left a legacy as profound and enduring as Jesse Livermore. His journey from a boy plunger to one of the most successful traders in Wall Street history is a testament to timeless principles that continue to shape modern trading practices. Livermore's insights, meticulously captured in Reminiscences of a Stock Operator, provide a masterclass in market speculation, with his system of pivotal points standing as a cornerstone of his extraordinary success. Understanding these pivotal points is not merely an academic exercise. It is a practical pathway to identifying and capitalizing on the significant market trends that define fortunes. A pivotal point, as conceived by Livermore, is a critical price level where a stock, after reaching a certain valuation, struggles to move beyond it or fall below it, only to eventually break through. This breakthrough then signals a potential for a substantial sustained movement or a definitive shift in the prevailing trend. It is at these precise junctures that a discerning trader finds the optimal moment to enter or exit a market position, significantly enhancing their probability of success. The concept demands not just keen observation, but immense patience, for the market rarely reveals its intentions prematurely. The art lies in waiting for the market itself to confirm a particular direction, allowing the price action to tell its story before committing capital. This patient, precise timing is paramount, distinguishing speculative success from mere gambling. Livermore understood that rushing into a trade based on intuition alone was a recipe for disaster. Instead, he advocated for a methodical approach, waiting for the market to align with his analysis, ensuring that when he acted, it was with conviction born of confirmation. The pivotal point is not a magic number, but a dynamic area where supply and demand are in delicate balance, and its eventual breach signifies a decisive victory for one side, setting the stage for a new phase of price discovery. This systematic approach eliminated much of the guesswork, allowing him to operate with a clarity that eluded many of his contemporaries. Identifying these pivotal points requires a sophisticated understanding of market mechanics, focusing on several key indicators. Central to Livermore's methodology was an unwavering reliance on pure price action. He viewed the raw movement of prices as the most honest and direct indicator of market sentiment, stripping away all noise and focusing on the underlying battle between buyers and sellers. He meticulously studied charts, not for complex patterns, but for the inherent logic in how prices behaved around certain levels. A stock's inability to break a certain high after multiple attempts, followed by a sudden, decisive move past that level, was a classic pivotal point setup. This required a deep intuition for how the market felt, an intuition honed over decades of intense observation and countless trades. He looked for clear, discernible patterns in the way prices moved, rejecting anything that seemed ambiguous or overly complex. The simplicity of his approach to price action was its strength, allowing him to cut through the extraneous information that often clouded other traders' judgments. Complementing price action, Livermore placed critical importance on analyzing trading volumes. Volume is the fuel that drives price movements. A significant price increase accompanied by robust volume indicates strong buying conviction, solidifying a bullish trend. Conversely, if prices rise on diminishing volume, it often signals underlying weakness, suggesting that the upward move lacks conviction and may soon falter. When a stock approaches a potential pivotal point, an increase in volume as it tests or breaks that level provides crucial confirmation. A breakout on low volume is often a false signal, a trap for the unwary. Livermore understood that without the backing of substantial trading activity, price movements were often unsustainable. A true breakout, a genuine pivotal point being crossed, would be accompanied by an unmistakable surge in volume, signifying broad market participation and commitment to the new direction. This interplay between price and volume was a constant theme in his analysis, providing a dual confirmation mechanism that greatly reduced the incidence of false signals. One of Livermore's signature strategies involved capitalizing on breakouts that occurred after prolonged periods of market consolidation. Consolidation phases are periods of relative calm, where a stock's price trades within a narrow range, indicating a temporary equilibrium between buyers and sellers. These periods are often precursors to significant moves, as pressure builds within the confined trading range. When the price finally breaks out of this consolidation, either to the upside or downside, it signifies a decisive shift in sentiment and the beginning of a new trend. Such breakouts, especially when accompanied by increasing volume, were considered prime pivotal points for Livermore. He patiently waited for these periods of quiet accumulation or distribution to resolve, knowing that the ensuing move would often be substantial. He did not attempt to predict the direction during consolidation, but waited for the market to declare its intent, entering only after the breakout was confirmed. This patient observation of consolidation patterns was a hallmark of his disciplined approach, preventing premature entries and ensuring he was positioned for the most powerful moves. Furthermore, the achievement of new price highs or lows served as potent pivotal points for Livermore. A stock reaching a new all-time high was not a signal to sell out of fear, but often a robust signal for further buying. It indicated that the stock had overcome all previous resistance, entering uncharted territory where there were no overhead sellers to impede its ascent. Similarly, a stock plummeting to a new all-time low was a strong signal for short selling, as it indicated a complete collapse of support and a potential for further declines. These new extremes represented psychological thresholds where the market's collective conviction was either overwhelmingly bullish or bearish. Livermore understood that these were not random occurrences but definitive statements from the market about a stock's underlying strength or weakness. He was not afraid to buy into strength or sell into weakness, recognizing that the market often rewards those who follow its lead rather than fight it. These new highs and lows were not merely data points. They were declarations of market intent, powerful signals that demanded attention and decisive action. Underlying all these specific identification methods was Livermore's profound understanding of market cycles and trends. He firmly believed that prices move in trends, and his focus was always on capturing the large, sustained movements rather than getting entangled in the minor, day-to-day fluctuations. The pivotal point system was precisely designed to help him identify these significant market shifts at their nascent stages, allowing him to position himself early in a trend and ride it for its full duration. He recognized that attempting to profit from every small wiggle was futile and ultimately unprofitable. His strategy was about patience, waiting for the big fish, and then holding on with conviction. He understood that the market's true profits lay in its major movements, and the pivotal points were his key to unlocking these opportunities. This macro perspective, combined with his micro-level analysis of price and volume, created a robust framework for long-term speculative success. He was a trend follower in the purest sense, using pivotal points as his entry and exit signals for these overarching market narratives. Once a potential pivotal point has been identified, the subsequent actions are as crucial as the identification itself. Livermore emphasized the imperative of entering a trade only after the market unequivocally confirms one's analysis. This means waiting for clear price action and volume confirmation, avoiding the temptation to anticipate a move. Premature entry, based on an unconfirmed hunch, was a common pitfall he rigorously avoided. He would rather miss the first few points of a move than enter too early and face a reversal. The market, in his view, always provided sufficient confirmation for those patient enough to wait. This confirmation was not a subtle hint but a clear declaration, often in the form of a decisive breakout on heavy volume. He sought undeniable evidence, a robust signal that left little room for doubt. This principle of confirmation protected him from numerous false starts and allowed him to commit capital with greater confidence. When the market does provide this confirmation, Livermore advocated for entering the trade as early as possible after the signal. This is not a contradiction to waiting for confirmation, but rather a distinction between anticipation and swift action once the signal is clear. Once the pivotal point is definitively breached and confirmed, delay can erode potential profits. The initial thrust after a breakout is often the most powerful, and capturing that momentum is key. This required decisive action and the courage to act on conviction. Hesitation, once the market had spoken, was as detrimental as premature action. He believed in striking while the iron was hot, capitalizing on the initial energy of a new trend. This early entry, post-confirmation, allowed him to secure a favorable position before the broader market fully recognized the shift, maximizing his potential gains as the trend matured. Risk management was a non-negotiable cornerstone of Livermore's trading philosophy. He famously stated that the paramount rule was to cut losses quickly and allow profits to run. This meant having a predefined stop-loss point for every trade, exiting immediately if the market moved against his position beyond that threshold. He viewed losses as tuition fees, an unavoidable cost of doing business, but insisted they be small and controlled. Crucially, he vehemently opposed the practice of averaging down on losing positions. Adding to a losing trade, in his view, was akin to throwing good money after bad, a desperate act that inevitably led to larger, more catastrophic losses. He understood that a losing trade was a signal that his initial analysis was incorrect, and the only logical response was to exit and reevaluate. This disciplined approach to capital preservation was fundamental to his long-term survival and prosperity in the volatile markets. It was a stark reminder that protecting capital was always the first priority, even above seeking profit. Discipline and patience were not just virtues for Livermore, they were the bedrock of his entire trading system. He often observed that many traders failed not because of a lack of intelligence or skill, but due to their inability to control their emotions and adhere to their own rules. The market, he believed, was designed to exploit human weaknesses: fear, greed, and impatience. Success required the mental fortitude to resist these urges, to wait for the perfect setup, and to execute trades without emotional interference. This unwavering discipline allowed him to sit idle for weeks or months if necessary, waiting for a clear, pivotal point to emerge, rather than forcing trades out of boredom or a desire for action. His patience was legendary, a testament to his understanding that the biggest profits came from waiting for the clearest opportunities, not from constant activity. He cultivated a mindset where he was content to do nothing until the market presented an undeniable opportunity. A fascinating aspect of Livermore's observation was the concept of a normal reaction after a breakout. After a stock breaks through a pivotal point and begins its move, it often experiences a temporary shallow pullback or consolidation. This normal reaction is characterized by lower trading volume, indicating that the initial momentum is momentarily pausing, but there is no significant selling pressure. Livermore saw this as a healthy sign, a natural breathing spell before the trend resumes with renewed vigor and increased volume. It was a test of conviction for many traders. The impatient would often exit during this pullback, only to watch the trend continue without them. He understood that not every minor dip was a reversal signal. Many were simply pauses, allowing the market to consolidate gains before the next leg up. Recognizing this normal reaction allowed him to hold through minor fluctuations, confident that the underlying trend remained intact and often presented an opportunity for those who missed the initial breakout to enter the trade. The lessons of the market are powerful, but they are often paid for with devastating losses. Jesse Livermore himself paid millions of dollars for his education, with each failure adding a new, invaluable rule to his trading arsenal. Fortunately, you do not have to pay the same steep price. The most effective way to accelerate your learning curve is to study the mistakes and successes of the masters. Edwin Lefebvre's classic Reminiscences of a Stock Operator is the ultimate case study in a speculator's career. It chronicles not just the legendary wins, but the brutal losses and the critical lessons learned from them. To extract every ounce of practical wisdom from this story, the detailed chapter-by-chapter analysis by Max Davidson is an indispensable tool. It transforms Livermore's life into a personal trading manual, breaking down each event to show you exactly what to do and what not to do in today's markets. To learn from Livermore's mistakes instead of your own, find the link to this invaluable resource in the description below. Beyond the technical aspects of identifying and acting on pivotal points, Livermore deeply understood the profound influence of psychology on trading success. He recognized that the market was not merely a collection of numbers, but a reflection of human emotions, particularly fear, greed, and the potent force of the herd instinct. These emotions, if unchecked, could derail even the most meticulously planned strategies. Traders often become overly optimistic during bull markets, leading to reckless speculation, and overly pessimistic during bear markets, leading to panic selling at the worst possible times. Livermore himself was not immune to these psychological pitfalls, but through painful experience, he learned to identify and mitigate their impact. He understood that the collective psychology of the crowd often led to irrational behavior, creating opportunities for those who could maintain a detached, objective perspective. His solution was an unwavering commitment to discipline and objectivity. He believed that successful trading demanded a rigorous control over one's emotions, refusing to allow personal hopes or fears to dictate trading decisions. The market, in his words, never lies, while opinions often lie. This profound statement encapsulates his philosophy. Trust the market's signals, its price action, and its volume, rather than one's own biases, predictions, or emotional impulses. He learned to detach himself from the outcome of individual trades, focusing instead on the execution of his system. This emotional detachment allowed him to cut losses without hesitation and let profits run without the fear of giving back gains. He cultivated a mindset that prioritized the objective reality of the market over any subjective feeling or desire. Livermore also warned against the common pitfall of not sitting still. Many traders, driven by impatience or the thrill of constant action, feel compelled to be in the market at all times, even when there are no clear signals. This tendency to overtrade, to force positions where none exist, often leads to unnecessary losses. He understood that significant profits came from waiting for the clearest, most undeniable setups, not from constant activity. The market often moves in cycles of clear trends and periods of indecision. During periods of indecision, the most profitable action is often no action at all. His discipline allowed him to remain on the sidelines, preserving capital until a true pivotal point emerged. This patience was not passive. It was an active decision to wait for the highest probability setups, understanding that capital was best deployed only when the odds were significantly in his favor. He valued capital preservation above all else, knowing that only by protecting his capital could he remain in the game to capitalize on the next big trend. To further refine his psychological and analytical edge, Livermore was a meticulous record keeper. He maintained a detailed trading journal, not just to track his trades, but to reflect on his thought process, his emotional state during trades, and the reasons behind his decisions. This systematic introspection allowed him to identify recurring patterns in his own behavior, understand his biases, and learn from both his successes and his failures. The journal was a tool for self-correction, a private mentor that helped him to continuously improve his discipline and objectivity. By documenting his expectations, his entries, his exits, and his emotional responses, he built a comprehensive database of his own trading psychology, allowing him to evolve as a speculator. This practice, though seemingly simple, was a powerful mechanism for turning raw experience into actionable wisdom, making his learning curve steeper and his insights deeper. Despite the profound technological transformations that have reshaped financial markets, the core principles of Jesse Livermore's pivotal point system remain remarkably relevant in modern trading. While high-frequency trading algorithms and complex derivatives now dominate significant portions of the market, the fundamental drivers of price movement, human psychology, supply and demand, and the tendency of prices to trend have not changed. Livermore's methods provide a timeless framework for identifying major trends and filtering out the pervasive noise that can overwhelm contemporary traders. In an era saturated with information, his emphasis on clear price action and confirming volume helps cut through the distractions and focus on what truly matters. The tools may have evolved from paper charts to sophisticated software, but the underlying logic of identifying key levels and waiting for decisive breaks remains as powerful as ever. His approach encourages an analytical mindset, one that is rigorously backed by market data, rather than speculative forecasts or fleeting rumors. He would not have been swayed by social media hype or unverified tips. Instead, he would have meticulously observed the price and volume around critical levels, waiting for the market itself to confirm a narrative. This data-driven discipline is more crucial today than ever, providing a necessary counterpoint to the emotional exuberance or panic that can quickly spread through digital channels. The principles of patience, discipline, and objective analysis are universal, transcending specific market conditions or technological advancements. He taught that one must always be a student of the market, letting the market dictate the terms, rather than imposing one's own will upon it. One of Livermore's most enduring observations: there is nothing new on Wall Street. What has happened in the stock market today has happened before and will happen again, perfectly encapsulates the enduring relevance of his system. Market cycles repeat because human nature, with its inherent fears and greed, remains constant. The pivotal point system, by focusing on these universal patterns of price behavior, offers a framework that is immune to the transient fads and innovations of the financial world. It is a system built on the unchanging truths of market dynamics, making it as applicable to cryptocurrency trading or forex as it was to the stock market of the early 20th century. By understanding these cyclical patterns and applying the disciplined identification of pivotal points, modern traders can position themselves to ride the next big wave, just as Livermore did. He taught that true success in speculation came from recognizing these enduring patterns and acting upon them with conviction and discipline. The best way to shorten your learning curve in speculation is to learn directly from the masters. The lessons of history, the memoirs of those who have navigated the treacherous waters of Wall Street and emerged with fortunes intact, are an invaluable education. To this end, a new channel, Wall Street Memoirs, has been created to serve as a library of this essential wisdom. This is not a channel for hot tips or fleeting market gossip. It is a repository of the timeless strategies, the hard-won philosophies, and the personal recollections of the legends who shaped the financial world. By studying their campaigns, their successes, and, just as importantly, their failures, you begin to understand the business of speculation at its highest level. You learn how they managed capital, how they analyzed conditions, and how they cultivated the discipline to act like true professionals. For anyone committed to learning from the best, Wall Street Memoirs is an essential resource. The link is in the description. In summary, Jesse Livermore's pivotal point system is far more than a simple trading tactic. It is a holistic philosophy for engaging with the markets. It is a testament to the power of observation, patience, and unwavering discipline. By focusing on critical price levels confirmed by volume and understanding the psychological undercurrents of the market, traders can learn to identify and capitalize on significant market movements before they become obvious to the masses. Livermore's legacy teaches us that true success in speculation comes not from predicting the future, but from reacting intelligently and dispassionately to the market's clear signals. His principles of cutting losses quickly, letting profits run, and waiting patiently for the highest probability setups remain as vital today as they were a century ago. Embracing this system requires a commitment to continuous learning, a rigorous adherence to personal rules, and the mental fortitude to adapt to the market's ever-changing landscape, just as Livermore himself did throughout his legendary career. The market always offers opportunities for those who are prepared, disciplined, and patient enough to recognize its pivotal moments.